In this module, we'll be considering tokenomics and market capitalization. Let's get into it. Tokenomics, a portmanteau of token and economics, is the mechanism through which a token is utilized in an ecosystem. It contains all the rules governing how a token is mined, spent, or distributed among all the respective players. A project will usually have information about the tokenomics even before the token is created in a process called TGE, Token Generation Event. I'll speak a bit on this. Now, the token generation event um, converts the token from a concept to an actual resident of the blockchain, right? So it will no longer be just something being, talked about or prepared or, uh, you know, something being conceptualized, right? It will become an actual digital asset, right? And it will become resident on the blockchain. You would be able to find it on the blockchain, right? So that's what happens during TGE. Moving on, the tokenomics will sometimes be part of the white paper or be contained in a separate document. A project's tokenomics may not have any bearing on the total on the token initially. Sorry, I beg your pardon, but it can play a significant role in the long term. By simple laws of demand and supply, it follows that any scarce commodity will go higher in price as long as demand for it is sustained. However, not all tokens will benefit from a fixed token supply. Token supply can either be inflationary, that is designed to increase, deflationary, designed to reduce, or fixed. A token that has a fixed total supply will eventually be worth a lot more as long as the project can sustain demand for it over the long term, like I have said, right, with its project offerings. If a token has a fixed or deflationary supply, it won't mean anything if nobody wants it anyway. In fact, an inflationary token will do better than one with fixed supply if the former has solid utility. So, in essence, the token's value usually, right, not always, usually, most of the time, will depend on the utility, not necessarily whether the token is, scarce or it's in high supply, right, in high availability. Basically, you need to prioritize utility over supply. That's what I'm saying essentially. Apart from the nature of supply, token distribution also needs to be considered. That's when you are looking at the whole tokenomics, right? If a team has allocated more than 30% of a token's total supply to itself, that usually doesn't bode well. Notice that I said usually, not always. No one factor should be used to judge the profitability or integrity of a cryptocurrency. You need to note this, okay? You should not use just one factor. You should not use, um, there's this particular team member that I really like, or there's this, big investor that has invested in it. No, you shouldn't. You should never use one factor to judge the profitability or integrity of a cryptocurrency. This is an example of a project tokenomics in terms of distribution, right? So the source is memepad.ai. Memepad is a project, right? So they have a total supply of 10 million tokens, right? 10 million tokens. Memenomics. Okay, so they are, playing around with tokenomics and they just called it memenomics, right? According to their name, meme pad. So memenomics. This is a meme, right? Tokenomics, just buy my tokens. So this says KOLs, which means key opinion leaders. They are going to give them 3%, probably to do marketing for them. This says early community investors. Okay, KOLs are basically people who have a lot of influence in crypto, right? Early community investors, 2%, strategic, this is probably strategic funding, most likely 14.5%. Then our launch pad 7%, public sale 3%, team 12%. That's fair. Marketing 15%, 14.5% ecosystem rewards, 9% development, 6% airdrop. Airdrop is also a marketing event. 3% DEX liquidity, so decentralized exchange liquidity, 3% community DEX liquidity, 8% SEX, that's centralized exchange or base liquidity. So basically, you can see that the this pie chart, right? You can see that the distribution is, is not focused too much in one particular area, right? So it's reasonably shared among the different parties, right? And then they have a lot um allocated towards this. Like strategic is like, things, activities that will build up the project, right, over the long term, and also development. So I mean, it shows that they have, a long term plan for the project and they are committed, right? So this is just an example, right? There are so many other things, there are so many other examples of tokenomics. A good rule of thumb is to go for projects whose tokenomics have a mix of fixed or reasonable or reasonably inflatable supply, I beg your pardon, and allocations reserved for marketing, project development, community rewards, and liquidity. Right. So all of these things move a project forward and help the project stay relevant for the long term. So marketing, creates buzz, helps other people know about the project. Project development, uh, you know, just makes every part of the project better, right? Helps them, hire more staff, make their existing project better. Let's say the project is a game, right? So it helps them, you know, make the gameplay better, add more difficult levels, make it endless, all of those stuff. Then community rewards. Obviously, if you have a project in crypto, right, you really can't do much without a good community of committed members, right? People who actually have, either a stake in the project's success, which is investors, or they just really like the project, like they fuck with it, right? So, and then liquidity, obviously, so it can continue to be tradable on exchanges. Market capitalization. So, like that's all on um tokenomics, right? I just ended it with this rule of thumb, right? So, moving on, market capitalization, the total worth of valuation of a project, gotten by multiplying the total number of tokens currently in circulation, that is the circulating supply, with the current price. That is, market cap equals circulating supply times price. It is incredibly essential to always determine the potential of a cryptocurrency based on its market cap and not its price alone. Price can be misleading on its own. Let me show you how. Let's consider two tokens, X and Y, with maximum total supply of 1 billion and 45 billion respectively. So these two tokens have a fixed supply, right? The price of one X token is $0.15, while that of one Y token is $0.02. Judging by price, token Y seems like the better deal. However, their market caps are 150 million and 900 million, respectively. So this is $150 million and $900 million respectively. A 100x move on token X puts the market cap at $15 billion, while the same 100x return, right, on Y puts the market cap at $90 billion. You want to be invested in coins that can give you a good return before getting to the $10 billion mark, as this in itself is an incredible feat, right? Not a lot of projects get to cross or hit that $10 billion mark. So it's an incredible feat in itself, right? Remember that in this course, we are considering crypto projects like any company on the stock market. The average market cap of a company in the S&P 500 index, which is an index of the most valuable companies in the world, is approximately $90 billion. Note that these are the most successful companies in the world, and some have existed for over 100 years. Most companies never get to the $10 billion mark. I said that. And so anticipating gains beyond this point is simply unrealistic. This is why you should ignore price as much as you can. Getting a token with a market cap under 200 million for $10 per one is better than getting another for less than $1 whose market cap is over $1 billion. This is one vital thing to note as an investor. Your goal is to make money, so you need to get into projects that will maximize your capital. Hence, the reason you should be concerned about market cap and not invest in any token whose market cap is close to or has surpassed the $90 billion mark. You could still make money, but the returns may not be optimal. Keep in mind, though, that the cryptocurrency industry is still in its infancy. Bitcoin is 15 years old and has enormous potential for growth. Many cryptocurrencies could very well surpass the $1 trillion mark within the next 100 years if we are still here. That's all for this module. Thank you for your time and see you in the next section.